This is NBR Today. AMP's new boss has deferred an initial public offer of its New Zealand wealth management and advice business until the wealth protection and other mature businesses are separated from the AMP group. The IPO was thought to have been proposed for a dual listing on the NZX and ASX, as the parent company is listed on both. But it's now thought new Chief Executive Francesco De Ferrari may be thinking over the plan. AMP also said it aims to complete its plans to sell its Australian and New Zealand wealth protection and other mature businesses to the British Resolution Life Group for 3.3 billion Australian by the end of the third quarter of this year, leaving the wealth and management businesses. The Australian-based company today announced a much reduced statutory net profit of 28 million Australian, compared with 848 million for the 2017 year, due to having to repay customers for bad advice and a subdued performance in wealth protection. National's finance spokeswoman Amy Adams has accused the government of putting the economy at risk by offending China. Ms Adams says the government has to do much better at insulating New Zealand from the impact of any slowdown in the global economy. While growth in China is slowing, Ms Adams points out that it's still growing at 6% a year, and it provides enormous opportunities for New Zealand exporters.
Well, the first thing we do is you don't piss off your major trading partner. And let's be really clear about this. China is our single biggest trading partner. It has one of the biggest economies in the world. And people talk about China slowing down, and it is, there's no doubt. But it's slowing down to about 6% growth a year. There are massive, massive opportunities for us in a growing Chinese market. And this is a government who can't even get the Chinese to pick up the phone when the Prime Minister calls. Our own Prime Minister, they won't see her because there's been so much antagonism.
There have been growing signs relations with China have become more problematic after the GCSB rejected Chinese company Huawei's bid to roll out Spark's 5G network because of significant network security risks. Trustee company PVG Securities is claiming a $1.6 million portion of the insurance payout on a Christchurch earthquake-damaged building owned by 100 Investments, of which former ACT Party leader Rodney Hyde is the sole director. The commercial building in Litchfield Street was demolished following the earthquakes in 2011. Its former owner, a company owned by controversial developer David Henderson, had gone into liquidation in late 2010. It was agreed that 100 Investments, who paid $1.3 million for the property, would receive the benefit of any insurance claim, which is understood to be nearly $3 million. But PVG argues 100 Investments is entitled to the insurance proceeds only up to the value of its loan security, and that the remainder is an asset of the liquidation. Industry training organisations are rejecting the government's proposed reform of vocational training announced earlier this week. Under the government's proposal, on-the-job training would become the responsibility of the new New Zealand Institute of Skills and Technology, which would also take over control of the country's 16 struggling polytechnics. Industry Training Federation CEO Josh Williams says while the polytechnics have been struggling, the ITOs have not. And he questions why the government would take training away from the industry and hand it to a central government agency.
But the bottom line for us is, why does the industry training organisation infrastructure that is not struggling, that has been performing well, that is doing as well now as it's ever done in the past, we have as many apprentices in our workforce today as we did in 1987 as a proportion of the workforce. Why is that baby going out with this bathwater?
Because you're being tarred with the polytechnic brush, aren't you?
That's exactly it. You've just stolen one of my lines, Grant. That's exactly it. This is a very large brush, and we've now apparently been tarred with it at fairly late notice.
Reserve Bank Governor Adrian Orr is standing firm on the central bank's plan to force banks to increase their capital, despite facing a barrage of questions on how the new requirements might affect customers, markets and banks. Mr. Orr said the Reserve Bank had calculated that there would be a 20 to 40 basis point movement in the margin between bank borrowing and lending as a transitionary impact. The Governor says capital levels have been used as a competitive advantage by the larger banks, and the new requirements would level the playing field for all banks. Meanwhile, Grant Robertson refused to respond to criticism of the Reserve Bank's plan, saying it's the bank's responsibility and he won't say anything which would challenge challenge its independence. He and Mr. Orr today signed the new charter that will govern the decision-making of the bank's new Monetary Policy Committee, which comes into effect on April 1. They also signed a new remit setting out the bank's dual objectives of keeping inflation between 1% and 3% and supporting maximum sustainable employment. And so to tomorrow we go. We see the return of NBR's weekly political wrap INQUEST for 2019 as the House resumed for the first time this year. And what a busy week it's been. Join me tomorrow as I discuss the week in politics with our political editor Brent Edwards and the University of Auckland's Professor Jennifer Curtin. Till then, have a good evening.
To unlock your 2 free articles a week, head to nbr.co.nz.